Hello and welcome to an episode of Monday Markets. As always, you're brought to you by Woo. Links available in the description below. BTC is trading at an all-time high, 72k at the time of recording. ETH is at 4k, and altcoins are broadly up across the board as well. So let's take a look at futures once again. If we start with the quarterly futures basis annualized, it's up at 24%. Now again, in terms of recent price action, is that high? Yes. In terms of historical highs, and this doesn't have the full data, but just to give us some context, is it high? I mean, yes, but not super frothy. And again, there are two things going on here. One is that you could expect when the market is very one-sided and everyone wants to be long, for the cost to be long to also be higher. So that's why we see a lot of the time funding rates being elevated, because there's an outsized demand to be long versus short. And so you need to find a way to incentivize or create pressure on the perp to trade closer to the index price. So if funding is high, that sort of sets up the trade where you buy spot, sell the future, and collect the funding rate, and generally makes it expensive to long to try to skew the incentives for participants to arb the difference and take the other side of the market. Now, as per my divergence tweet, which hopefully you've read, the more interesting setup isn't just that funding is high, therefore I'm going to short, or quarterly bases are getting blown out, therefore I'm going to short. I don't find that to be particularly compelling. What's more interesting is if you get a divergence between price and funding, which is to say that funding or premiums across the board getting increasingly elevated while the market is stalling or going down. That can become precarious. But if you are paying a lot in funding or just paying a lot to be long a market, but your P&L is more than paying for the cost of being long, which means price is going up, then it's really not an issue. Similar to momentum indicators during strong uptrends, that kind of stuff can stay overbought for a very, very long time and doesn't on its own provide a sell signal. Only when something else happens, like a divergence or price starts to break down or stall, only then does the momentum signal in that example sort of gain legitimacy. Similar in funding or just the cost of being long a market that's very strong and very one-sided. On its own, it's not a massive issue. It can become an issue if price starts to diverge from what participants are paying to be long. At the moment, I don't see particularly strong signs of that. If the market really starts to go sideways and funding and premiums continue to creep higher, we could start to raise an eyebrow. If the market starts to materially pull back and you still see a ton of premiums elevated across the board and buying the dip with leverage, we can raise the other eyebrow. But for the time being, if there's no divergence between price and the cost of being long, then the P&L from the long position more than pays for the expensive cost of being long in the first place. So there's no friction there. The friction emerges when you're paying a lot to be long and you're not getting paid. If you're paying a lot to be long and getting paid, then suddenly there's no friction, and so the likelihood that you become a forced seller or that there are some paper hands entering the fray, that likelihood is lower. So again, going up, but going up in a way that's concomitant. I might have just made up a word. Did I mean commensurate? Whatever, some sort of C word with price, okay? Funding shows a similar picture. If we look at perps, APRs, I mean, Deribit always kind of gets knocked around more than other venues. I think that's for options purposes, as someone left a comment some weeks ago. OKX, highest at 83% from a peak of 150. Now, again, even that's a pretty sizable deleveraging, at least in this venue, right? Sort of down 50%, essentially, the cost of being long during that period. Similarly, in Binance, went from 130 down to 60 at the moment. And that's not terribly crazy. I mean, considering even recent peaks and when BTC was making an all-time high, the market is trading at an all-time high now, and sort of 60-ish% APRs in most venues isn't completely mental. Now, Bybit and OKX, those venues are a bit more aggressive, so you can either look at the most aggressive venues or take an average view, but it's nothing particularly insane at the moment. Again, as long as, and this is the everlasting caveat, price continues to play ball. It's only when price doesn't play ball where we could become sort of give more weight to these indicators. If we look at the market as a whole, in terms of changes in price on the altcoin front, top gainers, I don't know most of these coins. I mean, I remember some of them and have seen them on my feed. ZRX, ID, BNX, PHP. This is, I mean, Floki's still up there. So some memes still keeping up. If we look at the, where are they? Top gainers, yes, the large caps, the boomer coins, Near is up the most, kind of an outlier. I think there's some NVIDIA AI thing narrative going on. And then you've got BNB and then your kind of standard boomer coins with the mean returns being I mean, roughly around 10-15%, I would say. So the market is getting lifted across the board for the time being, but there's nothing terrifying in terms of futures for now either. So that's the sort of zoomed out version of the market. If we take a technical view, 72k BTC, all-time high. I believe in the last Monday Markets episode, and you can feel free to correct me if I'm wrong, because I can't stand to rewatch my own content. The argument at the time was, historically, BTC has had some volatility around its all-time high price and has given some sort of spike, retrace price action. And if it were to do the same thing, that would not be a great opportunity to short, but rather if you could buy the dip on that type of stuff, that would be the preferred setup. And I think, unless I'm being far too charitable to myself, we may have spoken about the 61 to 62k breakout level, and that's pretty much exactly what happened, right? We had the all-time high spike, a big flush from participants positioning too aggressively for that breakout, ultimately ended up wicking some way below that daily structure, but closed above and has kind of marched higher since then. And hopefully at this point, what seemed like boring monologues taken in turn by DonAlt and I on Casual Friday when we were talking about the risk of being liquidated before things just go up, pretty much. It may have sounded like some sort of straw man or imaginary argument, but hopefully from even recent price action, you can kind of tell just how real and important that effect is. You must realize that there are participants who had very good BTC entries, or even kind of the correct view of BTC in the coming days and weeks, who essentially got pushed out of their position on one down day and are now watching the market trade significantly higher. Especially if we look at the tails, if you're getting liquidated at sub 60k and you're watching the market at 72k, you're probably not feeling very good. So that risk of forcing breakouts and trying to compensate for macro missed moves with excessive leverage, it's just not a particularly wise thing to do. I don't think it'll continue to be a wise decision. Now, that's always the case, right? The critique there is this is a generic don't use too much leverage herd type of argument, but I would say that it has special context in this instance because the cost of getting taken out of your position or getting liquidated when the market is presenting such volatility and so many opportunities is higher than it would ordinarily be. If anything, considering the volatility and the number of opportunities and just the general mean returns of crypto, it makes even less sense to use leverage because you don't need to. The market will move it for you. Now, understandably, if the market's moving 2-4% and you're in a dead boring range, then maybe some leverage is warranted there if the setup is good enough, or just to try to squeeze whatever you can out of price action that's a bit more dull. But if the price action is anything but dull, the only thing that leverage will do is force you to trade poorly, and there's also a really good chance that you won't be adjusted to the volatility either. So kind of unnecessary, right? Now, from a technical point of view, I mean, we're making new all-time highs. That's good. If you wanted to bear tard this, I think you'd be very hard-pressed to do so from the high time frame technicals. Even if you were sort of very patient, I think the earliest you would get a bearish case would be if this all-time high breakout were to fail and fall back below 58, 60k. Then this entire breakout would start to look dodgy. Boomer, triple top type of arguments would come into play, and so on and so forth. In general, at this point, it would be strange to materially spend a lot of time below the all-time high. We've already had all of our sort of gyrations and oscillations up, down, below, through it. So if you want to be really aggressive, the all-time high itself, if the market's going to offer significant follow-through, shouldn't be spending too much time there, and certainly not below it. But more conservatively, if we consider, as we have for some time, 59k as the macro range high, breakout level, whatever, you can move it up to the highest close on the monthly if you want. Doesn't really matter. 58, 59, 60k. This at the moment is forming as it closed as a breakout on this time frame, and we've had continuation since then. So the only instance in which the monthly time frame would give you a bearish setup, at the moment at least, would be back below 58k, and that's quite far away, and there'd be plenty of time to react on other time frames. Otherwise, given that we're pushing away from 58k at this time, anything else would have to be predicated on the price action we get post all-time high breakout. Some sort of new consolidation form that fails to break out and then it breaks down. Then you can say, aha, well, yeah, we're not at 58k, but now I've got more recent price action that suggests short to medium term weakness. But even then, given the all-time high context, you'd probably want to be a dip buyer first before considering a higher time frame bias shift. So monthly, I'm not going to overcomplicate it. Just breakout across the board. If the breakout fails, we can raise an eyebrow and say, well, that really shouldn't have happened. But absent that, I think lower time frames will be more helpful quite frankly. The weekly time frame, the last point I remember making on Monday markets about the weekly was essentially some version of whatever breakout we get out of this post ETF range will probably set the trend, and that's pretty much exactly what happened. I closed this way too early and didn't trade it particularly optimally, but in general, that seemed to play out. The thing about the weekly time frame is it suffers, and I use suffers in a very inappropriate way, from a similar defect as the monthly time frame, which is to say that now that we've cleared all these historical levels, unless we start getting failed breakouts, which doesn't seem super likely at the moment, and even then, you know, monthly, weekly, whatever, 58, 59, 60k, fine, but we're trading at 72, so that's not super relevant. Unless we start seeing those failed breakouts, even the weekly time frame will be of limited utility, much like the monthly, because it's a very slow moving time frame, and we don't have any historical reference points for this because by definition we're at an all-time high. So sure, you could use the range high at 59k to be your very early warning system for if this thing starts to get scary. You could use the all-time high itself and have the argument, or present the argument in your mind, that if we're going to get strong breakout continuation through all-time highs, it shouldn't be spending too much time below there. But absent that, even the weekly time frame, I think, until we reach such a time that we slow down, wherever that may be, and form new ranges, new consolidations, and whatever else to make the weekly time frame relevant once again, it probably isn't going to be your best friend. So really, in these instances, when you don't have any historical levels to look back on, you're going to need to use the lower time frames, daily, 4 hour, 1 hour, even 15-minute, to get some sort of frame of reference. Now, on the daily time frame, I think an adequate view thus far has been that breakouts stick, and if that changes, that would be your first reason to look for deeper dips or assume a short-term trend change. And even when I say trend change, it's still ultimately, at least in this context, want to be a dip buyer. It's just about picking your spots. And so just to elucidate that point, I mean, Don made the argument at 44k for a breakout. That was continuation. Then this mini consolidation broke out, never looked back. This mini consolidation broke out. And even though we had quite a nasty leverage flush come in after the all-time high tap, that same pattern of breakouts not failing has essentially persisted. And then there's a more recent version, or perhaps the most recent version, up at 68k as well, as a form of breakout that doesn't sort of give you any stress, essentially. And so I think going forward, or at least for this week, that's probably a useful framework to have if you're more higher time frame, daily time frame oriented. Candidly, the monthly and weekly, unless we really nuke sort of sub 60k type of thing, and I say really nuke sub 60k, sounds like an absurd statement, but just for contextual purposes. Unless we start getting into historical levels, I don't think the monthly and weekly time frame is going to be particularly useful. I think at least for this week and probably for the next couple of weeks, depending on how price action unfolds, of course, the daily time frame, the lower time frame is going to be much more pertinent to the price action. So BTC, I think, with the weekly, monthly disclaimers aside, as long as this trend of breakout continuation continues, God, that's a mouthful, I'm just going to assume strength until proven otherwise. And if one of these breakouts were to fail, so for example, price back below 68k, that doesn't give like a macro trend shift, like, okay, finally it's over, now we go down for 3-6 months. Your first assumption should be that this may give a dip, and I want a piece of that dip because the market is in an area of new all-time highs and there should be strength there. But in general, I think this is a decent way to track the market, and if you're in existing positions, to use it to at least move up your mental invalidations, and if not, to give you an idea of where to do business if you get lower time frame dips. And you can see even on the 4 hour, if we sort of look at those daily levels through a lower time frame lens, you essentially get the same levels, right? The 4 hour breakout level is the daily breakout level, similar structure at 62.5, and then all the way back at 52 as well. So I really think that's going to be the appropriate lens for viewing this type of price action. And if you want more entries, higher frequency of trades, then lo and behold, you just move your timeframes down. So the daily time frame will give you maybe 2 or 3 levels. Down to the hourly, you can look at more recent market structure levels for positioning, and just in general for looking for intraday rotations. And then depending on your trade frequency and preferred timeframes, you may even be well suited going down to the 15-minute if you're really aggressively low time frame trend following. Okay, but just to again reiterate the premise and concept from last video, when the market offers these all-time high or just in general really large breakouts that to some extent don't give you anything to work with because you're not going to be finding monthly and weekly support levels. If you want to trade levels, it's not like you throw everything out and say there are no more levels where we are going, we don't need levels. You just have to lower your time frames and you'll still get something. So that's BTC. Hopefully that makes sense or is somewhat helpful at least. I feel like last Monday markets would be much more helpful because this was essentially, this was a scenario we covered in great detail, the all-time high flush and dip buy, and at this point it's just basically last week's Monday markets unfolding since then. And if you're looking for a piece of the pie now, I would say that your only option really is much lower time frames and hope for either consolidations that give you an entry. So for example, consolidation, failed breakdown, and then gives you a low time frame entry and then invalidation, something like that, or something medium time frame where it comes back to retest one of these larger breakout levels, and then you're hoping for an entry at that point. But if you ever feel like chasing, you probably are. Something to be aware of. ETH BTC still hasn't really done all too much. I mean, this is essentially what we're dealing with. Now, is this impressive, given the fact that BTC has made a new all-time high and ETH BTC during that time has essentially held on to the same weekly range? I mean, yes, in terms of relative strength, certainly compared to this downtrend, this kind of slowing down of the downtrend is a good sign, especially because there's a lot of pressure from BTC performing so well. So that's good for ETH, but still, on its own terms, it's hard to make an argument for a rotation, at least in this specific point in the market, simply because it just hasn't done anything yet. You know, now yes, it has stopped going down, congratulations, but it hasn't sort of given evidence of or signs of outperformance for the time being. And I would be particularly hard pressed purely on shitETA to use sort of give my focus to ETH USD this week, because there, you know, this is kind of at its last weekly area at 4K essentially. Nice round number, weekly close below it. That's not a short ETH USD type of premise. As you'll recall, I think on that same episode of Monday Markets, I sort of pointed out that some market participants would be using 3K, 3.1, 3.3K as a resistance level, but contextually it's a crap level, and that's kind of exactly what happened. Now ultimately the level still ended up being useful because that's where the flash crash dip ended up settling, but in terms of resistance, it didn't really provide much. Now you could apply the same argument to this weekly level at 4K. I certainly have no interest in shorting it, but again, if we're on the balance of probabilities, if BTC is just ripping through all-time highs and ETH BTC is kind of sideways and ETH USD hasn't made new highs yet, I'd be hard pressed to make an argument for ETH over BTC at this exact time. So you know, if this is what the catch-up trade looks like, it hasn't been particularly compelling for a number of months now, and patience, at the very least, has been rewarded on the BTC versus ETH front. As far as altcoins go, I've got a random selection here, more or less. I think a lot of the AI meme narrative is focused around this NVIDIA blockchain, not NVIDIA blockchain, this NVIDIA conference meme coming up, and Near is a part of it, and so on and so forth. I don't think the conditions are particularly rife for a sell the news event necessarily. It's kind of just been ping pong between meme coins, metaverse coins, and on the weekend, meme coins, dog coins. No, okay, let me get this right. It's been ping pong between AI coins and meme coins. That's right. And then over the weekend, some random metaverse gaming stuff got sent as well. And then you had some boom rap performance. So there is some dispersion in altcoin land. The biggest risk there is that you become an ultimate rotator, or worse, an over rotator, where you buy something that's relatively strong. It's not strong the exact day you buy it. Maybe it goes sideways. You rotate to something that is strong, but then your original bag moons and your new bag instead consolidates. So you get trapped in this vicious and perpetual cycle where you're rotating the strong stuff at the top of that strong stuff and selling your would-be strong bags at their local bottoms. So kind of over trading and over rotating probably isn't a good idea. It's much better to have like few core positions that you think have significant upside and will benefit from whatever narrative takes shape, and trade those, as opposed to trying to both technically trade the market and then time the rotation within the market itself. There's just a lot going on there. So AGIX, I hope it's AGIX maybe. In any case, Don and I talked about it on Altcoin Thursday around this breakout point. It's gone up a lot since then, so that level isn't going to be super useful. Again, this is one of those where you work down your timeframes, which is where can I find some sort of structure to do business. The earliest structure you're going to get on the daily is at 95 to 81 cents. That would be quite a large pullback even from here, 20 to 30%. So okay, we'll bear that in mind, but it's not super close to the market. What else we got? If we go on the 4 hour, we've got some form of consolidation around this breakout level or the most recent market structure low at $1.20. Okay, that's slightly more relevant, slightly more interesting. Sort of if you want to be risk on altcoins when BTC is breaking its all-time high, it's relatively weak today, but again, there's just a lot of knee-jerk reaction and rotations in the crypto space at the moment. So if you still like AI, and this is one of the stronger AI coins, if it gives you a lower time frame setup, such as a failed breakdown, that could be interesting. Or even if it gives you a flush, which would be quite a big correction, but nonetheless, you never know with altcoins, especially if the whole market starts to slip a little bit. There's a larger area to do business sub $1. And then again, you can continue this exercise. You go down from the 4 hour to the hourly and actually see for a change, there's some nice confluence between the hourly and the 4 hour timeframes around $1.20 to $1.18. So that's kind of what the process looks like. You know, you start working your way down the timeframes. Like if I showed you this monthly chart and said where is support, you'd laugh at me and say you're insane. On the weekly, I would show you this chart on where's support. You'd say I'm slightly less insane. Maybe it's 52 cents, but that's not very helpful, right? Given the market's trading at $1.20. Go down to the daily, then suddenly we have 80 to 95 cents as separate levels. Okay, slightly less insane than the weekly and the monthly. At least we have levels, but even those are very far away. And then as you go to the 4 hour and the hourly, you start to become more sane, or at least have more data points to deal with, simply because the timeframes are lower. Yeah, more candlesticks, more data, more structures, and so on and so forth. So I think that type of process is very useful in these types of markets. AVAX is particularly strong today. I added this one to the watch list because there's a nice sort of invalidation structure that the market has broken through but isn't super far away, and I think that's a fairly self-evident range high at $44 in one form or another. If this thing is going to continue to outperform, that's a nice at least mental stop or invalidation if you trade that way, that if it's going to be strong or continue to be strong, it shouldn't go below that. And then as far as resistances go, well, it depends on your view. If you're very conservative, it's kind of already there at the weekly high, but no one's really buying altcoins to sell at weekly highs at the moment. The prevailing view is expansion for weeks and months, given the magnitude of a lot of these higher time frame breakouts. So again, $44 breakout as an invalidation, and then conservatively, if you want to be the European scalper, sorry, I just love those archetypes and stereotypes. Then 47 is your first trouble area, which isn't very helpful given that's well, it's already there and it's pretty close to 44. So you either ignore that because you're arguing for a higher time frame view, or if you want to be very particular about it, that's your kind of adjusted breakout level. But make no mistake, right? So you'll see sometimes this presented as a form of sophistication where it's like, well, look, there's a resistance here, and so if you break that one, then the market can go up. But it's essentially the same trade, right? Or at least it's a very similar trade in that if your argument for bullishness is the $44 break, then if that argument is to hold any weight at all, you can't say that it's a strong breakout but then expect it to turn around at 47. Either it's a strong breakout and it's going to crush 47, or it's not a strong breakout, in which case, why are you buying it in the first place, right? So there's not a material difference between buying the 47 breakout or buying the 44 breakout, because it's kind of the same trade. You're like breakout trading in the 40s, you know, it's not that deep, bro. But yeah, that's why AVAX is there. I just thought this was a nice level. And if the weekly expansion view is correct, there's a fair bit of space until, 50s, 60s, or just as a function of this larger consolidation breaking out. I always pay attention to strong performers on the day to see if there's any juice left to squeeze for the rest of the week. Filecoin as well. Similar argument in a sense, which is that, yes, high FDV, market cap, whatever, but it's a weekly breakout, right, through $9 to, well, $8.5, $9, whatever weekly anchor you want to use. Similar to a lot of altcoins that end up performing well. When the market flushed, got bought up quite quickly and quite aggressively, and has progressed since then. I don't really think it's useful to add any other structures. Even if we were adding the sort of 4 hour levels here or 4 hour pre-breakout structures, they all sort of converge around, $10 round number, $9.70. So if there's any strength to be had in terms of continuation, it shouldn't be closing below there at the very least. And similar to AVAX, and similar to how, again, a lot of people are viewing altcoins at the moment, the target is some version of multi-week expansion into historical levels. Most conservatively, that's the pre-breakdown level at $17. But again, if alt season gets particularly heated and crazy, then the first trouble areas almost always get rolled over. Floki, yeah, I don't know how much we talked about this. I don't exactly remember, but this is one of those where the monthly, the weekly, the daily, even the 4 hour to some extent aren't going to be giving you particularly useful bits of information. And it's really the hourly, 15-minute and everything, all those other time frames that if you want a piece of this, you'll have to get involved with. Because realistically, if you start from the weekly and say, okay, I'm going to buy weekly support, what are you going to do? You're going to wait for it to come back here. If you do, by the time it gets back there, the cycle's probably over and you don't want to be buying this thing in the first place. So again, it's that same process of working down the timeframes and finding some sort of invalidation on lower timeframes that would provide you with a trade idea that can be somewhat risk defined. Near, again, AI memes going on here. Weekly isn't going to be super useful. This one is on my radar because of that whole AI NVIDIA conference thing, but it's one of the trickier ones technically, because as mid-curve as it is, this is just a pretty, there's not as much space in this thing as in some other altcoins, just eyeballing sort of previous levels, kind of sort of at this first trouble area already. So I generally have a hard time trading this type of stuff. But again, if you want to put your high time frame blinders on, which is generally a good idea if you believe in a multi-week, multi-month trend, and focus exclusively on the lower timeframes, it would be the exact same process of trying to find a lower time frame invalidation. And instead of what you would normally do, which is to take a low time frame invalidation, hold it to a low time frame target, the way you adjust for trending conditions is you take your low time frame invalidation, but you hold it to a high time frame target. So normally there's some sort of mirroring effect where if the trade idea is predicated on the low time frame, it's also managed and exited on the low time frame. However, if you have a larger view of the market in terms of the days and weeks to come and volatility and magnitude of the move, you think it's really going to go up, then the high time frames can't really give you entries unless the market flash crashes. So then you have to make a mental adjustment, which is, yes, I'm going to use the low time frames for entries, etc., because I have to, but my target and management will actually be on the higher time frames, right? So normally time frames match, low time frame, but for a lot of these moves, given the relative lack of utility in the higher time frames, you essentially have to play low time frame games to win high time frame prizes. And it's that marriage of two disparate time frames that can give you pretty interesting swing trade setups. Pepe, again, meme coin, but since we spoke about it, up a lot. Don's favorite coin, didn't think he owns any, could be wrong. Sometimes he'll just message me on WhatsApp and show me some massive fuck off position size and says, what do you think? And I say, I think you should have told me that you were buying so I could actually make some money. Nevertheless, I'm not going to air our dirty laundry. That's what Fridays are for. Structurally, this one is a bit more tricky in terms of applying that methodology of moving between timeframes. I don't love the levels on this. I'm sure there's maybe some trend-based thing going on where there's a moving average that has kept this thing up that on lower time frames. The best I can arguably come up with, if it doesn't turbo flush, is 806. That seems to have kind of done the trick recently, and it's visible on a multitude of timeframes. And I think part of the reason why lower timeframes work is, I mean, as mentioned many times now, the high timeframes just aren't useful in terms of levels, but also the way that people are trading these and the participants coming into the market to trade these, they don't give a shit about the weekly and the monthly, right? They're on their phones at the barbershop making our yearly income on their phone. And if they're using their phone and trading a lot and sort of getting hooked into the ecosystem, they're not here for monthly and weekly time frame returns. They're here for 5 minute, 15 minute, 1 hour. So I think there's a bit of order herding and order clustering going on, and low time frames work better than they ordinarily would because of that as well. So that's not terrible at 806, but again, bear in mind leverage and volatility on these. Some levels will get really wicked through. RNDR, kind of just up only, right? This is quite an extraordinary recovery. I think this is also a sort of AI coin narrative beneficiary, if you will. I'm really hard pressed for structures on these types of diagonal grinds. I personally don't like them. If you do, or if there's a nice moving average that you can overlay onto this, be my guest. I would be hard pressed, but purely in terms of relative strength, can't exactly complain. I'm sure you could eyeball some form of range low if you're on the low time frame camp to say that I don't want it to break market structure, say $11. We've already had a wick through there as well. But yeah, same process. If you look on the monthly, you're not going to get anything. If you look on the weekly, nothing until what? $6, $4, and it's trading at 11, not useful. Daily, not super useful. I mean, unless it gets to 7. 4 hour, slightly more useful. We've got some sort of range low at 11, and then slightly deeper breakout levels, 10, nice round number, and then you end up in this, when you get confluence between timeframes, maybe you're onto something. So you can kind of see how this works, right? The monthly support is at 6, and that's far away from price. Weekly, slightly closer. Daily, slightly closer. 4 hours, slightly closer. 1 hour, slightly closer, so on and so forth, right? And so you kind of match the time frame with your urgency to trade. If there's a high urgency to trade, then you're going to have to use a lower time frame because that's going to give you something close to the market. If you have no urgency to trade, then you just do higher time frame stuff and either wait for some sort of larger mega correction dip, or you just sit the fuck out, realistically. My voice is going, so I'm going to speed through these. Sheeb, not useful on the weekly, not particularly anyway. Daily time frame, I think fairly self-evident, sort of lowest close or range low at 31.50, and then you could be slightly more generous as well on the 4 hour, including 26.60. So if this thing is going to be strong, it shouldn't really be breaking market structure on the lower time frames. And then you could do the same process of how badly do I want to trade this thing. Less badly, higher time frames, wait for gifts. More badly or more desperately, lower time frames. And the trade-off is that you play closer to the market, higher probability of an entry, higher probability of getting burned, further from the market, low probability of getting an entry, but also low probability of getting burned. Pick your poison, as we spoke about last week. The hat is still on the dog, I believe. $2, trade up to 250. I would just mention that when you're sizing these things, bear in mind the volatility, right? Especially if you're coming over from trading like BTC and ETH perps, you've got like a rough mental model for what your position sizes should look like given the average volatility. This just looks like a pullback, right? So let's take this leg here, just for example's sake. From this high that it broke out from, and then trading from range high to range low, just this leg here looks fairly innocent, and we know it's on the hourly time frame, so nothing mental going on, right? But if you measure it, that is a 20% move. You'd never guess, right? I mean, maybe you would if you can just do some maths using the y-axis, but in general, there's a lot of people that get trapped from moving. Well, the specific thing that gets them is that if you're used to trading BTC, you have a rough idea of, again, position sizes, volatility, what certain corrections look like on a given time frame, and then you head over to altcoins and work your way down the market caps. Suddenly, you're like, oh, it's an hourly pullback. That's down what, 5%? Oh shit, no, it's down 20, and now I'm liquidated, right? So always just get a sense of the size of the rotations, liquidity, volatility if you're trading new instruments, because there's absolutely no guarantee that your habit-based position sizing, which we all do to some extent, is accurate. So on the whiff side, again, same process. Monthly doesn't tell us anything. Weekly doesn't tell us anything. Daily could tell us something because these recent clusters haven't been violated. So $1.60, and then the closer one at a $1.80. That's somewhat helpful, at least. And if we go onto the hourly time frame, there is some confluence between those levels and sort of recent / historical range lows. If you want to get really aggressive, again, how close do you want to play to the market? You could always find some excuse, such as the range low at $2. And again, a lot of the time, the way this will pan out is that you have trader A who loves his higher time frame levels. He's here. And then you've got trader B who loves playing very close to the market. He's here. If the market does this, fantastic. Trader B is very happy because he played very close to the market. Trader A is sad because he didn't get filled and he has to wait for the next leg. But then eventually what happens is trader A is still playing very close to the market. He actually gets completely rolled over and it comes straight into trader A, trader B's, trader A's, whatever. The other guy, Bob and Rick, right? Rick loves to play close to the market. Bob stays further away and looks for gifts or dips. There will be times where Bob is smoking him because the market is barely pulling back and Rick is left sidelined and seething, and other times when the local low time frame close to the market structure breaks and there's a larger correction. At that point, the more patient trader gets his entry and then potentially more upside as well. What you don't want to do is be kind of stuck at an extreme where you're just kind of looking to buy every 1 minute support level and go all in on that trade, or you're stuck on the monthly waiting for the market to go to 12K type of thing. That's not particularly helpful. I think getting a decent view that makes sense for your personal trading frequency, risk appetite, etc., and basically picking a lane makes more sense while being aware of the trade-offs. That's something I can't emphasize enough. There are no free lunches. If you trade very close to the market, there's a risk that when a slightly larger than usual correction kicks in, you get burned. And if you play further from the market, the risk is that you will just get sidelined and not get entries on these big moves, or get them much later than you'd like. Yeah, that's all I've got to say. Hopefully that was helpful, and let me know if you have any feedback, comments, questions, concerns, other stuff you want me to cover. This show is for you, so I'll make any adjustments that I feel like I have some right or knowledge to talk about. Thank you to Woo for supporting the show. Hope you'll have a wonderful weekend, or had a wonderful weekend and have a wonderful week. I'm going to shut up. Yeah, stay alive, guys. Bye-bye.